Diversification. Diversify, diversify, or diversify. Okay, so how many stocks should you have in your portfolio? Sounds like an easy question, yet many investors and traders don't know the answer. Take a guess. 3, 10, 30, or 50? Okay, before I answer that for you, let me share with you two pieces of conventional wisdom that actually contradict each other. Don't put your eggs in one basket, and put all your eggs in one basket, and watch that basket like a hawk. But what no one tells you is how many eggs you should have in the basket in the first place. That ends today. If you want to diversify your portfolio, reduce your risk, there's only one number you need to remember going forward, and that is 10. Yes, 10 stocks or assets. I recommend 5, but 10 is the maximum. So you want to spread your capital across different assets to reduce your risk. But within an asset class like stocks, you want no more than 10. Anything more is scientifically stupid. Unless you're a full-time manager with a team of analysts, you'll find it difficult to monitor even 5 or more stocks properly. Trust me, I have experience monitoring private and public companies, and it's not something you might enjoy doing full-time. I'd rather make money. When I designed my trading lifestyle, I wanted to make sure that I had a life, and yes, become a lifestyle trader. I don't spend my whole day glued to the screen. I have a family, and I have a life, and I enjoy spending my life. So in case you're curious as to why it's 10, let's have a look at the research that backs this up. A study by Professor Statman in the Journal of Quantitative Finance showed that by the time you add the third stock, the benefits of diversification substantially reduce. After 5 stocks, it may not be effective at all. This chart illustrates risk versus diversification. If you recall, we talked about managing risk and how it was very important to investing and trading. And here's where we touch upon that again. As the number of stocks in the portfolio increases, the level of risk has been reduced. In fact, after adding the first 3 stocks, you can see the level of risk doesn't change that much. In plain simple English, don't have more than 10 stocks in your portfolio. It's unwise, it's stupid, it's difficult to manage. Why create your own stress? Okay, so do you know the difference between diversification and balance? If not, you should. They're two different things. Let's take an example. Imagine you have an equal portfolio of stocks and bonds, 50-50. This may be a diversified portfolio, but it doesn't mean it's a balanced one. That's because stocks are generally riskier than bonds, let's say 3 times. What this means is that your portfolio is unbalanced, with a higher risk of 75%. The math is simple. Let's just take 50 units of stock, multiply it by a risk factor of 3, and that's 150 of real value. So if you want to know the total, that's 150 stocks of real value and 50 units of bonds. Together that's 200. So 150 by 200 gets you 75%. Okay, so why is this important? Well, I'll repeat it again. Investing is about managing risk, and we want to reduce it as much as possible. Remember, take care of your downside and the upside will take care of itself. Does diversification work? Is it a real protector of wealth? If you do it properly across asset classes, the answer is yes. This is what we talked about in the section on asset allocation. If you want to refresh your memory, check out that section again. But each asset class is different. While some go up, others go down. Even within an asset class like stocks, some move in tandem, others with a lag. So how do you prepare for a black swan event? What's a black swan event? That's an unexpected event. You have options. Yes, options. The first is to take an insurance policy, or what we'd call a literal stock option, or some may call it hedging with options. But there's another way. You could have an exit strategy before you even enter a trade or investment. I'll share that with you. And there's another strategy called trailing stops. We'll talk more about that next.